Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as StockCharts.com. So today I want to cover off, is technology's cliff dive here? And I know that's a relatively rough start, but the point I want to get across is how critical the juncture we're at is. We don't know if this is where it's going, but a lot of the charts are telling me that's where it's going. So I want to focus in on technology. If you wanted a kind of a broader capsule, that's what we offer over at Osprey Strategic. I just can't cover it all in a short period of time. But the SPY is struggling at the 100-period moving average. And what does that mean? Well, roughly that is the 20-week moving average. And so that's the middle of the Bollinger Bands on a weekly chart. So that's a little bit of an important area for us. The second thing is small caps are starting to outperform. And I saw some tweets this morning that's bullish. And then I saw another tweet that, if the market's down here from here and for the rest of the year, it's going to do this. And it's, I get so tired of that because it's really got to be checked against what the charts are currently doing. And that kind of hype is really hard for people to make money from. So I want to cover off, is technology about to plummet? And of course, we got the warnings from NVIDIA and Micron today and yesterday. So I'm recording this on Tuesday. I think it's a critical time to pay attention. So if you would like a broader macro picture, I cover off bonds, stocks, equities, and commodities. Bonds, currencies, equities, and commodities on the Osprey Strategic website each week for my members. And try a 1-month membership at just $7 or a 1-year membership for about $17 a week. And the big thing there is it just takes a while to understand the cycles that we're trying to work through with the Schnell strength indexes. So you'll get an award-winning technical analysis newsletter and video, a monthly recorded conference call, and trade setups, at least 5 a day from Dwight. And hopefully all of that can help you. But let's jump into the charts I want to cover off today. So first of all, this is the video that we sent out, and I titled it Broken Pieces this week because to me it looks like this rally is about to end and we're starting to roll over. And so in this email I sent out, I point out some of the things that are going on and why we need to be particularly careful this week. So XLK has reached its 200 DMA moving average, and this is kind of where you'd typically expect something to rally to and fail. And back in March, it made it above it for a couple of days and then started to descend. Here we got to just the bottom side of it, and we're struggling a little bit with the long-term picture. So that's a problem for me. And the reason that that's a problem is when you look at some of the big tech crashes, like in the year 2000, what you'll see is IWM outperformed SPY almost for the whole period from the 2000 market top to early in 2002. While the S&P was obviously falling and the NASDAQ was obviously falling even faster. But my point would be just because the IWM is outperforming doesn't mean tech or the market is ready to go higher. So I want to make that point very clear. I can roll this tape to 2007, 2008. And what you see here, small cap was underperforming until the end of the year. Does that sound familiar? And then in 08, all of a sudden, small caps were really outperforming. You must remember part of this was oil. And then we made the top in September. And you can see what happened here as small caps started to really outperform. Then the market rolled over pretty hard, and then everything was crashing. But people were huddling in large caps like Walmart while the small caps crashed. So just because IWM is outperforming is not necessarily a bullish thing. Now, if I move the tape all the way to today, what you'll see here is that when IWM outperforms In this case, it was on the back of COVID, so we came out and it took a while. Well, October happened, and you might remember everything took off, and we actually had that SPAC mania going on and all that kind of stuff. So yes, we had some outperformance there, but clearly, while the IWM has not outperformed during this downdraft, it has performed in line. My bigger issue when I look at charts like this, just in a macro picture, is during the bigger bull market in here, what do you see? You see the IWM underperforming. And during the early 2019 here, you had a brief period coming off the lows where IWM starts to outperform. So there is no, this is not a magic bullet to just say IWM is outperforming, and once that starts to happen, that's a really good thing. So here you see in 2021, after the big super surge, IWM starts to outperform again. You can see the relative strength at the top here starting to improve, and then sure enough, we fail again. Now, so IWM starting to outperform, but then it underperformed for 3 months, but we kept performing. So this is not a good metric to use to see if technology is going to outperform or whatever. This is like literally not a really good index. And so I want to just zoom in on the most recent period here. So here we are, the stock market top. Guess what happened? IWM was flat. All of a sudden it starts to outperform for a couple of days. Everybody got on the bandwagon. That literally marked the top for the NASDAQ. And the S&P went flat for a month. We started to outperform right near the top in March. And then all of a sudden, as the Russell started to underperform again, we made the top and the market came crashing down. So here we have a brief period where we started to outperform and the market's starting to roll over now. And so my next question would be, which way is this going to go? I would just say throw this in the garbage. This is not a tool to use for whether or not we're in the next bull market. So please just keep that in mind. Okay, so here's Ethereum, and what we see is Ethereum has been doing a pretty good job of risk on or risk off assessment. And right now, this goes back to the 11th of July. We have a 2-week trend line here that's starting to crack a little bit. But I think the most important thing here is the upside move has really kind of stalled out and it's not really working. If I roll this out one more month, it gets a little busy. But here's our low, and guess when the NASDAQ bottom? Well, June the 20th. And when did, or June the 17th, when did the NASDAQ top? The same time Ethereum topped back in November. So all of these things are connected a lot. And my big perspective here is momentum is waning on Ethereum, and we're starting to have this lower trend line here. We do not want to see this all of a sudden start to collapse down. So all through here, we've been making higher lows on the momentum indicator. Now we're making lower highs, and so that's a bit of a question mark. The real question is what happens right here. I don't have the answer. That you might have the answer when you watch this video because CPI data will come out. But my main concern here is the data looks a little soft, and I'm not seeing the type of price action I want to see. So as I mentioned, XLK stalling right at the 200 period moving average. If we just went back, I'm going to change this to weekly and then roll this out for whatever, let's just make it. But the idea being, that's 200 period moving average needs to change to a 40 period. There we go. So what we see here is lots of times we're supported by the 40-week moving average. And then when we stop being supported, like back in 07 and 08, that was a really important turning point. And we bounced up to it once, bounced up to it again, and then we fell away. If we can go back to 01, basically it was resistance right at the late 2000s. It became resistance in late 2001 after 9/11. And it was resistance on the way back up off the October 2002 lows as we came down into the March 2003 low. it continued to kind of frustrate investors, and then we moved above. Since then, we've had QE, so pretty much every dip below the moving average has been bought by the Fed to turn the market higher, and now we have this situation where we're literally on our second move down. So this is a bit of a concern, and I'm going to get into some of the other charts directly, but the point I want to make is I listened to a podcast from Jesse Felder just a couple of days ago, and this podcast is the one from May 11th that I think you'll find very valuable. Fred has been doing technology investing ideas for 30 some years. And what he noticed in 2000 and 2007 was a whole bunch of dynamics that went on in terms of how the technology area was being perceived by the market in general. And when it underwent change, their failure to recognize that something big was happening. And what he saw was that all of a sudden, an order book that was very, very full. What had happened was because it was so hard, let's say back in 2000, to get routers from Cisco, companies would have more routers than they needed on order. And then as that order book rolled on, everybody just kept ordering and ordering, making sure that they had orders placed. So basically factory allotments placed, and trucking companies will do this with trucks, and airlines will do it with Boeing, and you name it. Everybody kind of keeps putting orders in, knowing they can always cancel it sometime in the future. So then as the market starts to slow, they start to slow their orders, and their order book starts to slow. And then all of a sudden what happens is demand collapses because everybody's now slowing their order book. And so what was a downturn all of a sudden becomes a cliff drop. And that cliff drop on the order book is critical to understand that is a sign of a much bigger issue. And so this week we had two things go on. So anyway, this is Super Investors, and then go listen to Fred Hickey on keeping your head all about keeping your head when everybody else is losing theirs. So I want to go over here and just look at, two very popular charts. We've got AMD, which is, first of all, it's starting to roll down. Guess where? Around the 200-day. Let's go to NVIDIA. It's rolling down. Let's go to Micron. It's rolling down. All of these charts are breaking meaningfully. Now, that podcast from Fred was in May 11th, 2022, and yet he said around August or September, you should start seeing all these tech companies canceling orders, giving downward guidance. Well, we've already had a lot of the tech names start to say they're laying off staff. Shopify and Coinbase and Facebook or Meta. All of these companies are noticing a significant change in the business, and yet none of us want to believe it's here. So the two warnings from NVIDIA and Micron, I think we'd have to agree they're kind of leadership areas of the market, are starting to break down. The charts never made it back above the 200-day moving average, and they're just giving us data now that says the third and fourth quarter are going to be rough and very rough. That's pretty meaningful, and it's not something to overlook, is my main point. So if we go look at ARC, guess what? Sure enough, it tried to break out yesterday, that would be Monday, and immediately fell back inside what I call the crane structure. Some people call a rising wedge. But essentially it goes up, and then you end up with this dumbbell that comes straight off the bottom of this and drops out. So you've got a situation here where, I'll call it the biggest tech name around. The chart is starting to, it tried to break out and fail. There's a small company in Canada that does crypto, and this is the chart pattern that it had yesterday. Literally surged up, couldn't handle it, and pulled back. And you're going to see this failed breakout be something to really worry about. Look at the volume that came in, and we couldn't hold any of the breakout. So this is crypto related. Now, if we go to Coinbase, you'll see the same sort of thing. All of these charts are telling us something here, that The market tried to break out and is failing, and now we're getting these warnings from NVIDIA and Micron, and I think it's a really big deal. So I don't know how to communicate it any more clearly than literally trying to go through some of these charts. So we have two big areas of the market, or three big areas. We have cloud computing, or cybersecurity, cloud computing, software, semiconductors. You can go through each one of these chart lists, but my main point here is if you just look, I'm going to scroll right to the top, sorry. If you just look at these charts, here is trend micro, and you can see it's breaking above all-time highs. That's pretty bullish. That chart looked great to me. It's really the only one doing it. So here's Intel plummeting lower, Lockheed Martin defense, but they're involved in a lot of this cybersecurity. So anyway, that's trending lower. Qualisys, this chart is trying to break out this week, so that's an interesting one. IBM not really doing much. Fortinet continues to drift lower, already back near the lows of the last 6 months, so that's a little bit worrisome. The hack ETF for cybersecurity hasn't really got out of the base that it was building, so that's a little bit of a problem. OneSpan technology, that looks like it's not spanning much. Palo Alto Networks continues to drift lower near the low end of the range, so that's not really starting to work. Cyber, this one's not working. And here's CrowdStrike. And again, you see the 200 is support, and now you see it as resistance. We're at one of those critical spots. So when I look through these just to, real quickly, is there something that I want to own here? Not really. Maybe two out of the whole group, and it just starts to make us wonder, right? So we get to software. Here's 1 week, and we've got some nice moves here. This is I've sorted them by the scooter ranking. So the strongest stocks first, and we have quite a few stocks with a 90 handle. They've had a really aggressive move up, and we can quickly look through these. My main point that I want to make here is they have had some stellar moves. The real question is, where are they on the chart, and if technology rolls over, will we see these suffer? So let's just jump in and look at them again on a quick scan, just kind of rolling through them. So here's Aspen Technology. This to me looks like it's trying to double top, and it's probably going to break down. One Life Healthcare gapped up. This looks like an earnings. Paylocity Holdings gapped up and is just trying to flag up here. That looks pretty strong. Synopsys, and again, I've taken the strongest ones first. Here's Ping Identity. This thing just went boing, obviously on a buyout, and now just stuck sideways. Simulations Plus, that's a nice chart. PPO starting to give us a sell signal. Cadence Design Systems testing a prior high. Automated data processing breaking out. That looks pretty positive. So that one's hard to argue with. I would really want it to hold the breakout. If it started to roll back down below 245, that would probably concur with what I'm thinking. Another one that broke out on buyout. Kango, this one surged roughly, I'll call it the day the market bottomed, and then hasn't done anything since. Evolent Health, Atlassian, this one surged right up to, you guessed it, the 200-day moving average on lots of volume. So now we'll have to watch and see if it can go anywhere from there. Paycom sitting right around the 200-day. It is up above it, and it is trying to hold up today, up 0.38. And then Broadridge Financial, that chart still looks in an uptrend. Again, these are the strongest ones. So let me just go grab whatever, middle of the pack. And so what you see here is Bright Cove not really responding. Checkpoint Software, that doesn't look very good. eGain Communications, Dun & Bradstreet Holdings already rolling over. Here is Docebo, once a popular name, really hasn't had a whole bunch of mo even coming out of the base here. Yellow Group, this one doesn't look like much, still under the 200-day moving average. Repay Holdings, big surge and then giving it back here. So trying to get somebody to buy this breakout and then it fails. PagerDuty. So my main point is a lot of these charts are still broken. And I gave you the kind of top 20 there that were okay. That's a small group in a group of a couple hundred stocks, so that's not really helpful. And then when we go to semiconductors, here's what you see for intraday. These things are really getting hit hard, down 10% percentage change on here. It's a pretty red group, and so I think this is a day where we really need to take the signal and be aware of the potential for this to be telling us bigger things. And some people were saying, well, the good news about NVIDIA is it really didn't break down too hard yesterday. Well, this is the weekly chart, so it's down 12%. Your PPO, if it rolls over below zero, to me, that's a really negative place to be involved in a stock, and you want to be careful there. All of these charts are telling us something to be cautious about, and there's a few that are still holding on. And I'll remind you, in 2008, BlackBerry held on while Apple was going lower. And I think we all know how that ended. So just because something has a little bit of strength during a downward trend here, don't be so convinced that that trend will hold up all the way through to the other side. Just be aware that it might be time to take profits. And again, on my newsletter, I'm starting to notice broken pieces of this market are starting to change. We were having kind of all sectors up for 2 or 3 weeks in a row. Now, last week, we only had half the sectors turning higher. So this is the type of environment here where while we want to be bullish, and tomorrow's CPI print, let's just say it comes down a little bit, we still have high inflation, just it's not accelerating at the same level it was. That's the trick here. And so if you take cars as an example, I keep thinking, okay, well, eventually the economy is going to slow down. There will be enough cars available and whatever. But the real problem is if inflation is here and the material costs are going up, then we might not see cars lower in price, even though we're hitting a recession. And that's what changes the dynamic. I also saw a tweet. Somebody said, gasoline sales in July of 2022 were lower than they were in July of 20, so that means oil demand has peaked already. Well, that couldn't be further from the truth. We're talking about $1.75 gasoline versus $5 gasoline. And so the amount consumers paid for gasoline 2 years later was like 100% or more higher than back in 2020. That's a lot of money out of people's pockets. So if we talk about the total dollars spent on gasoline, it's more than double where we were before. And yet, so the volume's slightly lower. Well, people will change their behavior when gasoline hits $5 and $6. Anyway, the whole point of this exercise is I don't want to be caught on the wrong side of the trade, and the trade is starting to level off for me. Again, talking about the S&P 500. Okay, so here's your candlesticks, and if you look at the S&P 500, if it's red, it closed lower than the prior day. But if it's got a white hollow center, it closed higher than the open. So in this particular case, market closed here, then it closed here, then it closed here. So both of these are down days. One of them looks marginally positive, and if a chart just shows the candle color as green, if it closed above the open, it doesn't look too bad, because then you have this day, this day, this day. This day could be plus or minus green, and then this day could be green. So it looks like you could have, let's say, 5 out of 8 days green. When you say compared to the prior day, is it higher or lower? We've got 6 days now where we've had closes lower than the prior day. And again, since late July, we're now trading below where we were in July after 6 days. The market doesn't have a lot of momentum here, so I really want to be careful. And I think if you go head over to that podcast, take the time to listen in on Fred. I didn't know who he was before, but this podcast brought it to pretty good attention that at least be aware of his comments and try to use them as a backdrop for your investing. And then the second thing I would just say, if you would like to understand the broader picture and why I think the market is starting to break down, feel free to try the trial over at Osprey Strategic. Again, $7. and you can get a feel for what we're talking about. So with that, thank you for taking the time to join me on Market Buzz. Market Buzz airs Wednesday at 10:30 a.m. Eastern Time. You can also see the recording on StockCharts TV YouTube page. Stay safe and try and protect your portfolio here. If it pops higher, great. If it doesn't, good time to make sure that we capture the gains we had. Thanks. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.